Hello everybody, this is Brett. Today we'll be discussing Fasb Codification 805-20, which is the accounting for identifiable assets, assumption of liabilities, and non-controlling interest. This codification has several subtopics that we'll go through here, which number one is the cash flow uncertainties, which is referring to accounts in the cash flow statement that have adverse effects on the consolidated worksheet. Then we have leases between parent and subsidiary companies, contingent assets and liabilities, employee benefits, and assets held for sale. Now these are all special cases in which the entries on the consolidated work papers could be affected. And we'll be doing a CPA exam problem that reflects some of the upcoming effects as shown here. These three main points or three main takeaways that we have, they reflect the original name of the topic. So with assets, we are going to be recording all identifiable assets at the recorded or at the fair value. Liabilities, these are going to be assumed at the value in the books as of the acquisition date. And lastly, non-controlling interest is based on percent of the company that is not owned by the acquirer, and as well as the implied value of the company itself. Here's the CPA exam problem that we'll be looking at. We'll be filling out the debit and credit columns as well as the total column to get our assets for the consolidated companies to equal our liabilities and stockholders' equity for the consolidated companies. We'll be starting from the top. So the first steps that we have here, we skip cash and accounts receivable because there are no elimination entries here in this case that affect either of those accounts. So we'll be starting with inventory. And as you can see by the additional information shown, the reason that we are increasing inventory here is because it says that the fair value of the subsidiary's inventory is at $225. Whereas in the subsidiary's books it says that they only have $220. So we need to debit that $5 to get that up to the fair value. Secondly, we'll be eliminating the investment in subsidiary amount. We do this so that we do not double count the stockholders' equity accounts that are listed below, named stock, additional paid in capital, and retained earnings. So we will credit that by the purchase price. Next, we debit property, plant, and equipment in order to bring that up to its fair value of $175. They already had $100 recorded in the subsidiary books, and so we'll need to bring that up to $175 with a debit of $75. This next step, we're going to skip goodwill and come back to that in a little bit. So we'll start with intangibles here on this page, and as you can see in the additional information, identified intangibles are $200. So we will need to increase the subsidiary's books $200 because they did not have this recorded in their books before the acquisition. With that, we will calculate the goodwill, and if you look on over to the right side of the screen, there's a calculation here of goodwill of $525. But to show you exactly how we did that, we'll show you from top to bottom of this calculation that we started with purchase price, subtracted the fair value of the net assets, which was the $445 shown here, plus the $280 that we debited to the subsidiary's books. And then finally, we subtract the liabilities of that to get the fair value of our net assets of $575. And last but not least, to get the non-controlling interest, we need to take our purchase price of $770, divide that by our percentage of ownership, which is 70%, to get the implied value of the company as a whole, and then multiply that by the amount of interest in the company that our company does not own. So we'll multiply that by 30% to get $330. And with that, that will bring our goodwill calculation to $525. As you can see, our next step is to debit the stock, additional paid-in capital, and retained earnings accounts. We're doing this so as not to double count the amount that we've already shown in the parents' book. So we are going to debit the stock, additional paid-in capital, and retained earnings to clear out these accounts in the subsidiaries' books. And so now, as you can see, we have one more step, and that's figuring out the non-controlling interest, which we already calculated at $330. So we'll be crediting that in order to bring our non-controlling interest in the subsidiaries books up to $330. And finally, if you take a look at our totals column, our assets do equal our liabilities and stockholders' equity, every accountant's dream. And with that, we'll move on to how this affects partnerships. Now, finally, with partnerships, the thing to know about this is that these are similar to acquisitions of a corporation, but without the stock aspect. So there's two ideas that we'll need to know here. The idea of having a general partner and a limited partner. The difference is the ownership share. The ownership share of a general partner consists of the initial investment and share of liabilities, whereas a limited partner consists of only the property and cash that they bring into the company. So what does this change then with our original example? So here's a new example of what this looks like. Once we finish our calculations for this example, this would be at the forefront of the CPA exam problem that we saw before, in that our final answer here is going to be the amount of ownership that we have in our new partnership. The facts in this problem are that Enron Company acquires fraudulent CPAs LLP for $500,000. Enron's owner, Arthur Anderson, became a general partner of the firm. The firm had $200,000 in liabilities. And the initial investments from the other partners totaled $1 million. So let's see how we calculate this. As you can see, we take our initial investment, Arthur Anderson's initial investment, into the partnership, and we add his share of the liabilities. And because he is one of the four partners, he has a fourth share of the liabilities. And that is going to equal his basis for ownership. And next, we will take his basis for ownership and divide that by all of the partners' basis for ownerships to get the percent of ownership, which is 32%. And our second example is quite like it. The only difference here is that we do not use that $200,000 in liabilities in our calculation, because a limited liability or a limited partner does not have any liability in the case of the liabilities of the company, which is going to give us a slightly different percent of ownership at 33%. I hope these examples have given you a better idea of FASB